Let's move on to Brian H's question. He says, an article I read recently pointed out the difference between a money market account at a bank and a money market fund at a brokerage. I know we just talked about that on our SVB show. Are both okay to use for the emergency fund?
Okay, great. So Brian's question is, all right, it's confusing. Money market account, money market fund, one word difference. That one word makes a pretty big difference, right? Most people, when we think about our cash savings, and you hear people say, oh, go open a high yield savings account. Go to bankrate.com and go look at all the high yield and open up a high yield account. What you're most likely doing when you open that high yield savings account is you're opening a money market account. It is true blue, liquid available cash that you are holding. And these high yield payers, you know, some of the perennial ones you hear about are like Capital One or Marcus or Ally, you know, those types of companies. They're often money market accounts. Well, those are covered by FDIC Insurance, assuming the bank is a member of the FDIC. You can go to fdic.org, I think, Daniel, O-R-G, and you can go actually look up the bank to make sure your bank is indeed FDIC insured. So long as you're working with an FDIC bank and you have a money market account, your cash deposits are covered up to the insurable limits by the full faith and credit of the federal government. So if you're a single depositor, that's up to $250,000. If you're a joint depositor, that's up to $500,000. That is a money market account. Well, there's another type of investment that's gotten really popular right now with rates rising. Was it FDIC.org?
I think it's FDIC.gov. I was just slacking with Daniel before I officially said it.
Quick rewind to make me sound smart right there. Rewind to make me sound like I got that right.
It is FDIC.gov.
FDIC.gov to go check.
You were close.
I was close. To go check that out. Well, then there are money market mutual funds, which is exactly what it sounds like. It is a mutual fund. It's an investment vehicle, investment company that invests in cash and cash equivalents. When I say that, that means it's only like commercial paper, which is like short-term government debt issues, treasury bills, treasury repurchase obligations, certificates of deposit, all these different cash instruments. And because it's an investment account, they likely can earn a slightly higher yield. Now, it is, don't mishear me. Money market mutual funds are an investment. And theoretically, they are subject to loss in principal. Like it's not, if you remember back in the day when we talk about breaking the buck, that's what that means. The value, the goal of all of these money market mutual funds, they want to keep the value exactly at $1, right? Theoretically, if we saw like some crazy seismic things, it can change. You could have principal value loss. But what these companies like Fidelity and Vanguard and Schwab try to do is they try really hard to risk mitigate so that that doesn't happen, so that your money market mutual fund does indeed feel like your money market account. Again, full disclosure, there are investment risks inherent in those, albeit if you're working with a large reputable company, they try to really, really minimize that. And one of the things you can do is you can go look up the composition of the money market mutual fund that you're holding. So like I mentioned, you know, if you know about this SVB thing that happened, this bank had to take some losses on their balance sheet. It's because they had a bunch of long-term bonds. If you go look at one of like Fidelity's money market mutual funds, I want to say like 87% of the fixed income that they're holding inside that fund is dated less than 30 days. That is not long-term. That's pretty liquid. You can look at the liquidity requirements that regulators make these funds hold and make sure that the fund you're using has a margin above that. It kind of shows conservative stewardship, conservative management. Well, money market mutual fund, I'm getting so in the weeds. I'm sorry.
It's great. I think people like that.
Money market mutual funds are not covered by FDIC insurance. Rather, they are a security. They are an investment company. They're covered by a different type of insurance called SIPC Insurance, which says if there's some malfeasance or some fraud perpetrated by the company that's sponsoring that, so like Fidelity, if Fidelity does something wonky that's illegal, SIPC will step in to protect up to $500,000 of security value. Now, the big brokerage houses, the Fidelities, the Charles Schwab's, the Vanguards, they recognize they want people holding more in their accounts than $500,000. They want you holding millions of dollars there. So what they do is they volitionally choose to go out and buy excess SIPC coverage to protect against their own fraud, their own malfeasance, so that their investors, so that their customers can feel comfortable. So money market accounts and money market mutual funds are not the same. You can think of them like cousins. They try to do the same thing, but they got a different genetic makeup, right? Both are acceptable places to park your emergency cash reserves, in my opinion. Now, I'm going to tell you what I do personally. I do sort of a 2-account system, right? Right now, money market mutual funds, high payer. So I got my cash sitting in something paying 4.5% for like my emergency fund. I also have a checking account that I use for my day-to-day clearing, right? So I have a brick and mortar checking where I can walk down the street, see the person, and I keep X amount of dollars in there. So as deposits come in and withdrawals go out, it's there. And then I keep this separate tier account where I keep my emergency fund, and I just keep a link between the two. So if I need to move money back and forth, I can. I don't think that's a crazy way to go about navigating it. Like all things, go into it eyes wide open. Money market account, money market mutual fund, not the same thing. They have different risks inherent. Make sure you are aware of and comfortable with those risks before you put your dollars there. But I think either one can work as a holding place for emergency reserves.